What happens when the world's factory slams its doors on America's biggest industries? The question hung in the air like a premonition as dawn broke over Washington, D.C. on April 1, 2025. While cherry blossoms painted the National Mall in delicate pink, an economic thunderstorm was brewing across the Pacific. At 9 a.m. Beijing time, China's Ministry of Commerce released a statement that would send shockwaves through global markets. Effective immediately, all exports of rare earth elements, processed graphite, and 17 other critical materials to the United States were suspended indefinitely. Within minutes, trading floors from New York to London erupted in chaos. Executives at General Motors' Renaissance Center headquarters in Detroit stared in disbelief at their phones. Inside Tesla's Gigafactory in Nevada, engineers gathered around monitors, calculating how long their existing stockpiles might last. The answer: weeks, not months. "This isn't just another trade spat," said Michael Chen, chief supply chain analyst at Goldman Sachs. "This is the economic equivalent of cutting oxygen to a patient." The seeds of this crisis were planted years ago. In 2018, President Trump fired the first shot with tariffs targeting $34 billion of Chinese goods. The trade war escalated through successive administrations, with President Biden imposing 100% duties on Chinese electric vehicles in 2024, citing unfair competition and national security concerns. But few anticipated China's nuclear option. "We've been watching this dependency grow for decades," explained Dr. Sarah Wilson, geologist with the U.S. Geological Survey. "China controls approximately 80% of global rare earth processing capacity. These aren't just obscure minerals, they're the lifeblood of modern manufacturing." The numbers tell the story. Neodymium for the magnets in everything from headphones to wind turbines. Lanthanum for catalytic converters. Yttrium for LED displays. And critically, graphite, where China commands 65% of global production, essential for the anodes in every lithium-ion battery powering America's electric vehicle revolution. At Ford's sprawling plant in Dearborn, Michigan, the assembly lines for the F-150 Lightning continued to move, but executives knew the clock was ticking. Each vehicle required nearly 90 pounds of rare earth materials. Without new shipments, production forecasts would soon become fantasy. "The irony is breathtaking," noted Senator Mark Warner during an emergency Senate Commerce Committee briefing. "We've spent billions incentivizing a transition to electric vehicles through the Inflation Reduction Act, only to find ourselves more dependent on China than ever before." The vulnerability extended beyond automotive. In 2024 alone, the U.S. imported $34 billion in computers and electronic components from China, according to Yahoo Finance data. Each device contained trace amounts of materials now under embargo. As markets closed that first day, the Dow had plummeted 1,200 points. Tech stocks led the bloodbath, with Apple down 8.2% on supply chain concerns. The WTI crude oil benchmark jumped 5% as traders bet on a return to internal combustion engines. Inside the Department of Commerce, staffers worked through the night, pulling data from shelved contingency plans. The strategic reserves of rare earths established in 2022 would cover less than 3 months of normal consumption. Alternative suppliers like Australia, Vietnam, and Malaysia could potentially ramp up production, but not quickly enough to prevent disruption. As President Trump convened an emergency cabinet meeting, the question on everyone's mind was simple yet devastating. How did America let this happen? The warning signs had been flashing for years. Congressional hearings in 2020 highlighted the vulnerability. Think tanks published white papers. Military planners raised alarms about defense applications dependent on Chinese materials. Yet, the economic logic of globalization proved too seductive. Cheaper materials meant lower prices for American consumers. Quarterly profits took precedence over strategic independence. Now, as night fell on that first day of the ban, The consequences of those decisions were about to cascade through the American economy with devastating force. And this was only the beginning. 2 weeks into China's export ban, America's industrial heartland was experiencing economic cardiac arrest. Outside Detroit, the sprawling GM assembly plant in Hamtramck, renamed Factory Zero, during its billion-dollar conversion to EV production, had fallen eerily silent. The facility, which had once hummed with the promise of an electric future, stood as a steel and concrete monument to strategic miscalculation. "We're implementing a temporary production pause," read the corporate statement, a euphemism for the layoff notices distributed to 3,200 workers. Similar scenes played out across the country as the ban's ripple effects intensified. The numbers painted a grim picture. According to Reuters data, a staggering 95% of U.S. rare earth imports came directly from China or passed through Chinese processing facilities. Alternative supply chains existed only on PowerPoint slides in corporate boardrooms, theoretical lifeboats for a ship already taking on water. "We're looking at a 30% reduction in EV production capacity for 2025, said Maria Gonzalez, lead automotive analyst at Cox Automotive. And that's the optimistic scenario, assuming some materials can be diverted from consumer electronics. On Wall Street, the bloodletting continued. Goldman Sachs published a report titled Manufacturing's Bleak Outlook, projecting a potential 2.3% hit to GDP if the ban extended beyond 6 months. The Philadelphia Semiconductor Index had shed 22% of its value, with analysts warning that restrictions on gallium and germanium, critical for chip manufacturing, could cripple everything from smartphones to military radar systems. Inside Best Buy stores nationwide, limited availability signs appeared on shelves as inventory managers rationed remaining stocks of laptops and tablets. Online marketplaces saw price gouging emerge, with scalpers charging 40% premiums for devices that might soon become unobtainable. The battery supply chain faced particular devastation. Bloomberg reported lithium-ion battery prices spiking 20% overnight as manufacturers competed for dwindling graphite supplies. EATL and LG Energy Solution, major battery suppliers to U.S. automakers, warned clients of force majeure events due to material shortages. On Twitter, Elon Musk's characteristically blunt assessment sent Tesla stock tumbling further. Significant production challenges ahead. Working 24/7 on material substitution may accelerate lithium iron phosphate transition for standard range vehicles. But industry insiders knew the truth. Material substitution required years of R&D, not weeks of panic engineering. The ban's reach extended far beyond vehicles. General Electric's wind turbine division announced delays in fulfilling $1.2 billion in orders. Raytheon executives held closed-door meetings with Pentagon officials about defense systems dependent on Chinese materials. Even medical device manufacturers raised alarms about MRI machines requiring rare earth magnets. In Washington, the political blame game accelerated faster than proposed solutions. Republican lawmakers criticized decades of green energy fantasies without securing supply chains. Democrats pointed to blocked legislation that would have expanded domestic mining. Meanwhile, the State Department's diplomatic overtures to Beijing met with stony silence. "This is strategic economic warfare," declared Senator Josh Hawley during a fiery floor speech. "China has weaponized our own dependency against us." For ordinary Americans, the crisis materialized in unexpected ways. At dealerships across the country, EV prices jumped an average of $8,500 as dealers applied market adjustments to dwindling inventory. Gas prices climbed 12% as consumers reconsidered traditional vehicles, overwhelming refineries calibrated for declining demand. Construction projects faced their own reckoning. CBRE projected a 5% increase in commercial building costs due to material shortages, not just from direct impact, but from cascading substitution effects as manufacturers competed for alternatives. Solar installation companies, unable to secure inverter components, began furloughing workers despite bulging order books. In Silicon Valley, a different kind of panic took hold. Venture capital funding for hardware startups evaporated overnight. "No one wants to back a company that can't secure their supply chain," explained Jennifer Wong, partner at Andreessen Horowitz. "We're shifting focus to software and services until the materials situation stabilizes." By the third week, the first bankruptcies emerged. Proterra, a leading electric bus manufacturer already struggling with tight margins, filed for Chapter 11 protection. 3 battery startups followed suit, unable to meet contractual obligations without access to critical materials. At the Port of Long Beach, container traffic dropped 17% as ships from China arrived with conspicuously lighter loads. Customs officials reported Chinese exporters finding creative ways to reclassify products, removing components containing restricted materials before shipment. "They're sending us smartphones without the vibration motors that use rare earths," explained one customs inspector. "Companies are supposed to install them after import, but there's no supply." As April gave way to May, America's manufacturing resilience faced its greatest test since World War II. Domestic mining operations in Mountain Pass, California, the nation's only rare earth production facility, announced plans to double output. But industry experts noted the painful truth. Increased ore extraction without processing capacity was like pumping water through a straw. And in this new reality, China controlled the pipeline. The economic damage continued accumulating like radiation, invisible but increasingly destructive. Consumer confidence indexes recorded their steepest monthly decline in history. The Federal Reserve convened an emergency meeting to discuss interest rate responses to simultaneous supply shocks and inflationary pressure. Yet these immediate disruptions merely foreshadowed the deeper geopolitical shift underway, a transformation that would permanently alter America's position in the global economy. And the most shocking developments were still to come. As May 2025 unfolded, the unthinkable became routine. America's industrial landscape had transformed into a patchwork of operational and idle facilities, determined not by efficiency or demand, but by access to increasingly scarce materials. In Fremont, California, Tesla's original Gigafactory operated at 40% capacity, prioritizing high-margin vehicles while standard range models remained in production limbo. Similar scenes played out across the manufacturing sector as companies implemented triage protocols, allocating dwindling resources to their most profitable products. "We're seeing a fundamental restructuring of American industry in real time," said Dr. Eleanor Park, economist at MIT. "The speed is unprecedented. Supply chains built over decades are being dismantled in weeks." The economic data told a sobering story. The U.S. Bureau of Labor Statistics reported manufacturing jobs declining by 187,000 in a single month, the steepest drop since the 2020 pandemic. CBRE's prediction of a 5% construction cost increase proved optimistic as prices for alternative materials soared amid frantic substitution efforts. Then came the first reports that would change everything. On May 12th, Reuters published a seemingly routine article noting unusual shipping patterns. Chinese exports of graphite and processed rare earths to Canada had increased 340% year-over-year in April, despite global production remaining relatively stable. The implications were clear to industry insiders. China wasn't reducing production, it was redirecting it. "They're creating a material apartheid," explained James Chen, former Commerce Department advisor. "Resources flow freely to friendly nations while being denied to strategic competitors." Canadian ports in Vancouver and Montreal reported record volumes as Chinese bulk carriers unloaded unprecedented quantities of the very materials American industries desperately needed. Within days, satellite imagery confirmed similar patterns at ports in Mexico and throughout Latin America. For American companies, this presented an agonizing scenario. Their international competitors retained access to critical materials through third countries, while U.S. operations withered under the ban. Even more concerning, Chinese manufacturers, particularly in the EV sector, continued production unabated. BYD, China's electric vehicle giant, announced ambitious plans to double overseas sales to 800,000 vehicles in 2025. With premium access to their domestic material supply chain, their production costs remained stable while American and European automakers struggled with soaring input prices. "This isn't just a temporary disruption," warned Janet Miller, chief strategist at Morgan Stanley. "It's a permanent realignment of global manufacturing competitiveness." The White House response proved inadequate against this sophisticated economic strategy. Diplomatic pressure on Canada yielded sympathetic statements but little concrete action. Canadian officials quietly pointed to their $123 billion in annual oil exports to the U.S. per Statistics Canada, leverage too powerful to ignore in bilateral discussions. "We're caught in a classic prisoner's dilemma," admitted one State Department official speaking on condition of anonymity. "Every ally has individual incentives to maintain their Chinese supply relationships, even as the collective Western position weakens." By June, American manufacturing faced bifurcation into two distinct tiers: companies with multinational operations able to access materials through foreign subsidiaries, and purely domestic producers increasingly uncompetitive in global markets. The consequences for American communities proved devastating. In Georgetown, Kentucky, Toyota's decision to shift production emphasis to Canadian facilities rippled through the local economy. In Normal, Illinois, Rivian's electric truck plant reduced operations to 3 days weekly. Each manufacturing job lost triggered an estimated 7.4 additional job losses in surrounding service industries. Wall Street finally recognized the structural nature of the crisis. J.P. Morgan's America's Manufacturing Renaissance postponed indefinitely. Report triggered another market sell-off. Pension funds began quietly reducing exposure to U.S. manufacturing sector equities, accelerating capital flight. Perhaps most alarmingly, China's strategy extended beyond immediate economic pressure. Intelligence sources reported Chinese representatives approaching mineral-rich countries in Africa and South America with comprehensive development packages contingent on preferential resource agreements. "They're building the next century's supply chain," testified CIA Director William Burns during a classified Senate briefing, details of which later leaked to the press. "This isn't about winning a trade dispute. It's about permanent resource realignment." The American response finally gained urgency. Congress passed the Critical Materials Security Act with rare bipartisan support, allocating $47 billion for domestic processing facilities and offering tax incentives for new mining operations. But industry experts noted the uncomfortable truth. Even with unlimited funding, new facilities would require 3 to 5 years to reach operational capacity. In the meantime, America turned to allies with existing capabilities. Australia, controlling approximately 17% of global rare earth deposits according to USGS data, found itself the recipient of unprecedented American diplomatic attention. Similar outreach targeted Vietnam, Malaysia, and Brazil, countries with modest but developable resources. Yet China's first-mover advantage proved difficult to overcome. Chinese mining companies had spent the previous decade securing long-term extraction rights across these same regions. Many promising deposits remained undeveloped but contractually encumbered. By mid-June, a new economic reality had emerged. American companies began adjusting to a world of material scarcity and structural disadvantage. Ford announced plans to revitalize combustion engine production lines. Intel accelerated research into alternative semiconductor materials. GE unveiled redesigned wind turbines requiring 40% less neodymium. But adaptation came at a steep cost. American technological leadership, built on presumptions of material abundance, faced unprecedented challenges. Innovation timelines stretched as R&D resources diverted to material substitution rather than breakthrough technologies. Most concerning to national security officials, defense contractors reported growing backlogs in military production schedules. The F-35 fighter program, dependent on rare earth components for everything from precision guidance to radar systems, faced component shortages with strategic implications beyond economic concerns. As summer 2025 approached, a profound question echoed through policy circles, corporate boardrooms, and kitchen tables across America. Was this the moment China finally took the driver's seat in the global economy? The material ban had evolved from a tactical trade dispute into a strategic inflection point, one that would determine whether the 21st century's economic architecture would be designed in Washington or Beijing. For an America built on presumptions of resource security and manufacturing superiority, the answer remained uncomfortably uncertain.